and welcome to Money, Money, Money. It's that time of the year again when newspaper ads and television ads will remind you of the glittering yellow metal. Yes, I'm talking about Akshaya Tritiya, that day of the Hindu calendar when buying gold is considered auspicious and good for the growth of your own personal wealth. So as you decide on your gold purchases, we thought it would be nice to get you some timely advice. Tradition aside, is this a good time to be buying gold? How much of it should you have in your portfolio? And what are the best ways to buy the yellow metal? Joining me on the show today to answer all of those questions is CA Harsh Rungta, who's also a SEBI-registered independent financial advisor. Thanks, Mr. Rungta, for joining us on the show today. It's great to have you here, and we wish you season's greetings. And I don't know if you're thinking of buying gold or not this Akshaya Tritiya. Why don't you tell me, is this a good time to buy gold?
Well, I think any investment, so traditions are good, but any investments need to be part of your overall plan. I mean, if it's a token investment that you do which does not affect your investment holdings, it's another matter. But if it's going to be a substantial sum, then it needs to be part of your overall plan. And I think gold has to be a certain, you do need to have gold, especially in an Indian investment portfolio. But I would say, depending on your outlook, 5% to 10% maximum of your investment can be in gold. If it is, as far as my advice is concerned, I would tend towards the lower end of the portfolio rather than the upper end.
Okay. So, Mr. Rungta, just to contrast this, obviously gold has been a rank outperformer. I mean, we're talking about almost double-digit gains from last Akshaya Tritiya, which fell in April, to this year's festival, which is on the 9th of May. Equities have actually underperformed. The benchmark index is down 6 to 7% in the same period. Do you see this kind of outperformance continuing, or was that a sort of a one-off issue because of the, the import duty, etc., and a lot of the other norms, that have been changing around?
So I think in the past we have clearly seen that gold keeps pace with inflation. Typically, if you look at 30-year moving averages, 10-year moving averages over the last 30 years, it's about just a shade of double digits, about 9.5%. I think clearly inflation has been around 7.5%, 8%. So it beats inflation with a margin. If you take the tax out of it, just about beats inflation. So I think given if we continue to have lower inflation going forward, if we continue to have that, we may see slightly muted appreciation in gold. Over long term, I think an post-tax appreciation equivalent to inflation is what you should expect from gold.
Now, of course, today there are many ways in which you can buy gold. It's not just going to your neighborhood jeweler and, buying a little, either a coin or a piece of jewelry. So I just want to spend some time understanding some of the newer avenues, gold ETFs, gold bond scheme, and then the gold monetization scheme. Why don't we start by looking at the gold bond scheme itself, because that's a sovereign-backed scheme where you can be completely rest assured about your investment. How does it work? Is it tax efficient? And is it advisable?
So as far as gold bond is concerned, as you have clearly mentioned, it's a sovereign-backed scheme. And clearly you are assured. It's a government security. You get a certain interest, which is taxable. And at the end of 8 years, you will get back the value of the gold that you have invested. So if you have invested in 10 grams of gold, you invest at today's value. So suppose that today's value is say 3,000 rupees a gram. You invested 10 grams, you would pay 30,000 rupees for 10 bonds. The 2.75% interest every year would be calculated on 30,000. Okay. Irrespective of what happens to the value of the gold over these 8 years.
Oh, okay.
At the end of 8 years, you would get back 10 gram money equivalent to 10 grams worth of gold. Let's say it doubles.
Along with the interest, of course, but on
the interest is available to you every year.
Oh, so the interest is paid out every year.
The interest is paid out every year. In fact, it's paid out every 6 months. 2.75 divided by 2. The value of say 10 grams has grown from say 30,000 to 60,000. At that time you would get back 60,000 rupees. You can't get back 10 grams of gold.
Okay. What happens to capital gains? Because if gold is appreciated so much and if there are capital gains involved, then what is the treatment there?
So for gold bonds, if you redeem at the end of 8 years, there won't be any capital gains tax.
Okay.
If you redeem at the end of 8 years.
Okay.
You're allowed to redeem any time after 5 years. Again, if you redeem it in the government window, you can redeem it on the interest payment dates. On those days, again, there will be no capital gains
But
tax.
again, redemption is allowed only after 5 years. So that's
Only
one
after
caveat.
5 years.
You have to lock in that investment for at least 5 years. And you can redeem after 5 years on certain designated interest payout dates, you're saying.
That's right. But it's not locked in. You can freely transfer it at any point. So you can, so if I hold a gold bond, I can transfer it to you.
Okay.
There, when I transfer it to you, capital gains tax would be payable. If I have held it for more than 3 years, I would get indexation benefit.
Okay.
But I would have to pay long-term capital gains tax if I have held it for more than 3 years. If I have held it for less than 3 years, I would pay tax on it like any other regular asset.
All right, so that's all about the gold bond scheme. What about gold ETFs? They're a slightly older product. They've been around in the market. Do you see the gold bond scheme sort of cannibalizing that market at all? What are the pros and cons of being in a gold ETF vis-a-vis, subscribing to gold bonds?
So if you look on paper, after gold bonds have come, gold ETFs make no sense. Right, because in gold bonds you actually get interest on whatever you invest in.
In addition to your investment in gold, yeah.
Right. When you invest in gold ETF, there is a charge that you pay to the fund house, typically around 1% per annum. So on one side, there is a depreciation in the value about 1% per annum. On the gold bond, on the other hand, you're getting 2.75% per annum appreciation, or you're getting interest. I will not say appreciation. So on paper, ETFs don't make any sense. However, there are two big issues with gold bond. One, it's not available on tap. Okay, that's one. So if I want to buy today, I can't buy today. I have to wait for a tranche.
Right.
Other big advantage that ETFs have, which gold bond doesn't have. One, you can't buy it on tap. Second, you can do a SIP in a, not in an ETF, you can do a SIP in a gold fund, which in turn invests in an ETF. So it adds to costs, but the convenience factor, especially for the small person, somebody say
who doesn't have that lump sum of certain 30, 40, 50,000.
So for a retail investor who's systematically investing in gold, ETFs continue to make some amount of sense purely, not ETFs, I would say gold funds that invest in ETFs make some amount of sense purely from convenience perspective.
But one has to keep in mind that they are more costly because you're paying a fee to the fund house to manage that investment for you. Okay, so we will take a quick break on that note, but when we come back, we'll be talking about the government's gold monetization scheme. How does that work? Would it make sense for you as a retail investor? Find out after the break.